All right, we've got to talk about something that is a real head scratcher. You've got the stock market hitting all-time highs, but the reason why? Well, it's basically bad news. So how in the world does that work? Let's get into it.
So first up, the good news, right? The S&P 500, the Nasdaq, they're just smashing records. Looking at this, you'd think the economy must be absolutely firing on all cylinders. But here's the thing. That's not what's happening at all.
And this is where it gets weird. The one thing that lit a fire under the market and sent stocks soaring was a report showing the U.S. job market is way, way weaker than anybody thought. So why are investors popping champagne over what sounds like terrible news for everyone else?
Okay, to really get the market's strange reaction, we have to dig into the data that lit the fuse. And, this wasn't just another piece of economic news. This was a genuine shock to the system.
So the headline number for jobs in July, it showed that hiring slowed down a lot. It came in way below what all the economists were predicting. And right away, that sent a signal that the economic engine might be starting to sputter. But that wasn't even the full story.
And believe it or not, it actually gets worse. On top of those weak July numbers, the government went back and revised the numbers for the last couple of months. And poof, over 250,000 jobs we thought were there just vanished. This wasn't just a slowdown. It was a sign the economy was already a lot cooler than we realized. Which brings us right to the big question. Why on earth is bad news suddenly good news for stocks? Well, it really all comes down to a pretty simple chain reaction.
Okay, so here's how it works. Step 1, the weak jobs data comes out. Step 2, investors immediately bet that the Federal Reserve has to step in and cut interest rates to give the economy a boost. Step 3, because of that, government bond yields start to fall, making them a less exciting place to put your money. And that leads to step 4. With bonds looking kind of dull, all that money needs a new home, and it floods right into stocks, pushing the whole market up.
And we're not just talking about a vague hope here. No, the market is practically screaming for a rate cut. As of right now, traders are pricing in a nearly 100% certainty that the Fed is going to act in September. It's a massive, totally one-sided bet that cheaper money is on the way.
Now, this whole bad news is good news thing, it's not lifting all boats equally. Not at all. In fact, what it's doing is creating some very clear winners and some very clear losers across the market.
So on the winning side, you've got your tech and growth stocks. For them, the idea of lower interest rates is like rocket fuel. It just makes their future earnings look that much better. You see a company like Live Nation still seeing super strong demand. But on the flip side, companies that really depend on a strong consumer, they're feeling the heat. Take a look at CAVA, the restaurant chain. Its stock took a hit on signs that growth is slowing. So this tells you, while the market is cheering for the Fed, it's also genuinely getting nervous about the health of the real economy.
This whole situation brings us to a major crossroads. The market is basically walking a tightrope between a huge opportunity and a huge risk, with two totally different ways this could all play out. So let's look at the bull case and then the bear case.
Okay, the bull case. This is the soft landing scenario everyone hopes for. The Fed cuts rates, and it works like a charm. It gives just enough of a boost to pump up asset prices and get things like housing and cars moving again, all without the economy actually falling into a painful recession. It's really the best of both worlds.
But then you have the bear case. What if this weak jobs report wasn't just a blip? What if it's the first real sign of a coming recession? If that happens, a Fed rate cut isn't going to be some magic pill. It won't be enough to stop company profits from falling as people get scared and stop spending. That soft landing could turn into a nosedive fast. So with these two very different paths ahead, what should you be watching for clues about which way we're actually heading? Well, there are a few really key pieces of data coming up that the entire market is going to have its eyes glued to.
Coming up this week, we get a fresh look at inflation with the Producer Price Index. Then, on Friday, we get two massive clues about the consumer. First, the official retail sales report. That tells us what people are actually spending. And second, the Consumer Sentiment Survey, which tells us how they're feeling. These numbers will either back up what the market is betting on, or they could throw a serious wrench in the works.
And that leaves us with the ultimate question, doesn't it? The market is betting on an economic slowdown because it expects a big reward from the Fed. But the line between a controlled, gentle slowdown and a full-blown nosedive is incredibly thin. Figuring out which one this is will be the key to everything in the months ahead. Thanks for joining The Explainer.